Today, we're digging into the thinking of, well, a true legend in the investing world, Warren Buffett, the Oracle of Omaha.
Right, and our mission really is to pull out the core wisdom from a whole stack of sources about him specifically, his most timeless rules for investing, the ones that still matter today.
Absolutely. I mean, you look at his track record turning a relatively small operation into Berkshire Hathaway, this, $700 billion giant. It's just staggering.
It really is, and it makes you ask, okay, how did he pull that off? And maybe more importantly for our listeners, how can you apply some of that thinking yourself?
Exactly. We've sifted through the material, and what emerges is essentially what some call the 10 greatest pieces of stock market advice from Buffett.
And they're surprisingly relevant, maybe even more relevant now with all the noise and distraction in the market.
Totally agree. So let's jump in. Where do we start? It has to be rule number one, right?
Has to be. The famous one. Rule number 1, never lose money. Rule no. 2, never forget rule no. 1.
Sounds simple. Maybe too simple. Like, how do you just never lose money?
Well, yeah, and that's the key. He doesn't mean you'll never have an investment dip or a trade go against you. That's, inevitable.
Okay, so what does he mean then?
It's about protecting your principal, your starting capital. It's about fundamentally avoiding unnecessary risks, looking really hard at the downside before you even dream about the upside.
So less about hitting home runs and more about not striking out catastrophically.
Exactly. Don't gamble on hype. Focus where you have a genuine edge, where you understand the risks deeply. It's the bedrock. Playing defense first, you could say.
Got it. Okay, that makes sense. What's number 2?
This one's a big mental shift for a lot of people. Buy businesses, not stocks.
Right. Think like an owner, not just a trader looking at a ticker symbol.
Precisely. He famously said something like, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes.
Wow. 10 years or 10 minutes. That really forces a different perspective.
It does. It pushes you to ask, do I actually want to be a part owner of this specific company? Do I understand how it makes money? What makes it durable? Not just, will this ticker go up tomorrow?
So understand the underlying business, its fundamentals. If you don't get it,
then you're probably just speculating, not investing in his view.
Okay. Moving on to number 3. This one feels very relevant today. Be fearful when others are greedy and greedy when others are fearful. Easier said than done, though.
Oh, absolutely. It's deeply counterintuitive. Your instinct is often to run with the herd. But Buffett's discipline here is legendary.
The sources mentioned examples, didn't they?
Yeah, really powerful ones. Think back to 2008. Financial crisis, world feels like it's ending, panic everywhere.
And Buffett's doing what?
He's buying bank stocks, big positions. Then again, early 2020, the pandemic hits, markets are plunging.
And he's betting on America's future.
Right. These moments of peak fear, peak pessimism, that's when he sees opportunity that others are too panicked to notice. It requires real emotional control.
So chaos for others is opportunity for the disciplined investor. Okay. Number 4.
Patience. Often called his real secret weapon.
In a world obsessed with speed and instant results, patience.
He put it bluntly, the stock market is designed to transfer money from the active to the patient.
Meaning you don't have to trade constantly.
Not at all. It's not about frantic activity. It's about finding good companies, making your investment, and then letting time and compounding do the heavy lifting.
Ah, the compounding effect. Like that snowball analogy he uses.
Exactly like the snowball. Starts small, rolls down the hill, gathers more snow, gets bigger and bigger, faster and faster over time. Patience lets the snowball grow.
Yeah, it's about consistency over frequency. I like that.
Definitely.
Okay. Number 5 is about knowing your limits. Avoid what you don't understand. Sticking to your circle of competence.
This is huge for him, and it requires, frankly, a degree of humility that's rare.
The famous example is tech stocks, right? He avoided them for years.
Yeah, for a long, long time. And it wasn't because he thought there were bad investments necessarily. He was very clear he just didn't feel he understood their business models or long-term competitive advantages well enough.
So the lesson is pretty direct.
Very. If you can't explain it simply, if you don't genuinely get it, don't put your money there. Stick to what you know.
Makes sense. Don't need to be an expert on everything. Number 6 is another don't try to time the market.
Yeah, he's very skeptical of forecasting. He has that great line.
The one about fortune tellers.
That's it. The only value of stock forecasters is to make fortune tellers look good.
Okay, so basically, trying to predict the absolute bottom to buy or the absolute top to sell is futile.
Pretty much. He argues it's impossible to do consistently. Energy is much better spent focusing on finding good businesses at reasonable prices and holding them. It's about time in the market, not timing the market.
Right, that distinction is key. But it feels like everyone's trying to time it. What's the big trap there?
The trap is usually emotional. You get greedy near the top, fearful near the bottom. You end up buying high and selling low, the exact opposite of what you want. His advice helps you resist those urges.
Okay, resist the urge. Got it. Number 7. Focus on value, not price. What's the core idea here?
It's understanding that the price tag on a stock isn't the same as its underlying or intrinsic worth. His quote is perfect. Price is what you pay, value is what you get.
So a high-priced stock could be cheap, and a low-priced one could be expensive.
Exactly. The sources used examples like, a $300 stock might actually be a bargain if the company behind it is incredibly profitable, well-led, and has amazing growth prospects.
Whereas a $5 stock
Could be a total value trap if the business is failing, poorly managed, or in a dying industry. The price alone tells you very little. You have to dig deeper.
Look under the hood. Profits, leadership potential, not just the sticker price.
That's the essence of value investing.
All right, number 8 brings us back to that snowball, the power of compounding. You mentioned he started investing super young, right?
Yeah, age 11, which is incredible. But what's maybe even more mind-blowing is that most of his enormous wealth was actually generated much later in life.
Really? Even after decades of investing?
Oh, yeah. Sources point out that even by age 60, the vast majority of his net worth was still ahead of him. Compounding takes time to really get going, to build momentum.
It starts slow.
And then, as he apparently described it, it takes off like a rocket. It's why starting early, even small, and just staying consistent is so incredibly powerful over the long term.
Let the snowball roll. Powerful lesson. Okay, number 9 is interesting. It's not about math or finance, but psychology. Temperament beats intelligence.
This is a crucial one. He strongly believes your emotional makeup, your disposition, is far more important for investment success than having a sky-high IQ.
Can too much intelligence actually hurt if you don't have the right temperament, like analysis paralysis?
Absolutely. Buffett said, the most important quality for an investor is temperament, not intellect. High intelligence might lead you to overcomplicate things or panic more easily because you see all the potential negative outcomes.
So what defines the right temperament?
It's asking yourself, can you stay rational when the market's crashing? Can you resist FOMO, the fear of missing out when everyone's piling into some hot trend? Can you stick to your plan and ignore the crowd?
That emotional discipline.
That's the edge. It's often harder to cultivate than financial knowledge, frankly.
I can see that. Which brings us to the final one, number 10. And it's maybe a bit unexpected coming from a finance guy. Invest in yourself first.
Yeah, it broadens the perspective beautifully, doesn't it? He says, anything you invest in yourself, you get back tenfold.
And he's not just talking about buying stocks here.
Not at all. He means investing in your own knowledge, your skills, your health, your communication abilities. Things like reading constantly, learning new things.
Things that make you more valuable.
Exactly, because those investments compound too, maybe even more powerfully than money. They improve your earning potential, your decision-making, your overall life. It's the foundation.
Your most valuable asset is you.
Wow.
Okay, let's quickly run through those 10 again.
Sure.
1, never lose money, protect that capital. 2, buy businesses, think like an owner. 3, be fearful when others are greedy, greedy when they're fearful. 4, patience is your superpower.
5, stick to what you understand, your circle of competence. 6, don't try to time the market. 7, focus on intrinsic value, not just the price tag. 8, harness the incredible force of compounding.
9, master your temperament, it beats raw IQ. And 10, invest in yourself above all else.
It's quite a list. And the sources really emphasize you don't need to be perfect at all 10. Even consistently applying, say, half of these principles puts you way ahead of the game.
Because it's based on timeless wisdom, not temporary tricks.
Precisely. It's about discipline, patience, and rationality, things that build his fortune over decades, not overnight.
Which leaves us with a final thought for you, the listener. Thinking about that discipline, that long-term patience in Buffett's rules, especially that last one about investing in yourself. How might applying that mindset transform things beyond just your portfolio? What other areas of your life could benefit from that kind of consistent, thoughtful effort to build true, lasting wealth, whatever that means to you?
Something definitely worth thinking about.
Indeed. That's all for this deep dive. Thanks for joining us.